Good morning, everybody. Welcome to our 12th and our final webinar for 2017. And in this webinar, we're looking at the new IFRS 9 and specifically the new hedging requirements. Now, the outline of this webinar, 5 sections. First of all, the background to the development of IFRS 9, specifically the hedging part. The second one, we look at the current status of IFRS 9. And then in the third section, so what is hedge accounting? In the fourth section, and that's important because there's a few changes there, what are the new qualifying criteria for hedge accounting? So you would know currently under AASB 139, it's not easy to qualify for hedge accounting. And so there are new qualifying criteria which are a bit easier, and therefore we look at that at length. And then also the last section, what are the consequences of ineffectiveness following your initial hedge recognition? You'll see that in this webinar, we're not looking at calculations or extensive amount of examples. Do that in a webinar next year. At this stage, it's just an overview of what's changed in this space. So if we look at the background to the development of IFRS 9, which is our first section, first of all, the question really is, so why do we need a new hedge accounting model? Now, hedge accounting rules under IAS 39 or AASB 139 are strict, they're complex and difficult to apply. Some examples are you had to have hedge effectiveness in a range of 80 to 125%. Your effectiveness testing, your hedge effectiveness testing must be done on a retrospective and a prospective basis, and that hedge effectiveness testing had to be on a quantitative basis. It was quite restrictive also as what can qualify as hedged items, not times, hedged items. And then the use of options and forwards still led to profit and loss volatility. So a number of issues around hedge accounting in the current AASB 139. And therefore, it deterred many companies from using derivatives to hedge their risks. If we look at, it jumps the whole time, what are the key benefits of IFRS 9? So first of all, more hedging arrangements are likely to qualify for hedge accounting. So we're looking at less artificial profit or loss volatility. Because more hedging arrangements qualify for hedge accounting, it would reduce P&L volatility. Also, the second benefit, it's less complex and onerous if you look at the ongoing compliance requirements. So that strict limit that your hedge effectiveness has to be within 80 and 125% has been eliminated. The third benefit is that you now have the ability to hedge components of non-financial items. Also, you've got the ability to hedge net foreign exchange cash positions, and then also the ability to more effectively hedge account for exposures that give rise to two risk positions. And then also there's reduced profit and loss volatility from using options. So a number of benefits if you qualify for hedge accounting, if you get into the details, a number of benefits of using IFRS 9. So what's unchanged from AASB 139? I think it's important to look at that as well. Not everything has changed. So cash flow, fair value, and the net investment models are retained. You still measure hedge effectiveness, so you still have to do that. Hedge ineffectiveness still has to be reported in profit or loss. Your hedge documentation is still required, And hedge accounting will remain optional on a hedge-by-hedge basis. So that's important. Nobody is forcing you to do hedge accounting if you qualify for hedge accounting. Hedge accounting remains optional on a hedge-by-hedge basis. So a number of things remain unchanged from AASB 139. So before we go on, let's look at the current status of IFRS 9. So the current status, the final version of IFRS 9 was issued in July 2014, so it's a number of years, more than 3 years ago. The mandatory effective date is periods beginning on or after 1 January 2018, so we are really on the final countdown to that mandatory effective date. If you've got a 30 June year end, your mandatory first period would be 30 June 2019, but you would already be in your comparative period. If you look at IFRS 9, IFRS 9 provides an accounting policy choice where entities can either continue to apply the hedge accounting requirements of the current IAS 39 or AASB 139, or entities can apply IFRS 9. So you've got an accounting policy choice there. Now, this accounting policy choice will apply to all hedge accounting and cannot be made on a hedge-by-hedge basis. So you either apply AASB 139 to all hedge accounting, or you apply IFRS 9 to all hedge accounting. So it's an all in or out. Still continuing on the current status of IFRS 9, the IASB decided to split hedge accounting into two separate work streams because hedge accounting is such a complex topic. They've split it into general hedge accounting, so that is for one-to-one or static hedge relationships, and I would imagine that if our clients do hedge accounting, that's the kind of hedge relationships we'll be looking at, general hedge accounting. The second stream is macro hedge accounting. Now, this is for more dynamic hedging relationships of portfolios of financial assets and financial liabilities where the hedge positions change constantly. So that would more be financial institutions and banks that would be using that. So the IASB is currently still deliberating on that macro hedge accounting model. And therefore, the rest of this webinar, we focus on the general hedge accounting model because that's what I think most of our clients would potentially be using, and that's the part that's been finalized by the IASB. So that's all background on what is IFRS 9 and what's the background to the development. The question therefore is, so what is hedge accounting? Now, first of all, before we look at hedge accounting, I think it's important to start with the statement that economic hedging doesn't necessarily equal that hedge accounting. So economic hedging is not the same as hedge accounting. So let's start with, so what is economic hedging? If you look at economic hedging, all entities are exposed to some form of market risk. So if you're a gold mine, you're exposed to the price of gold. If you're a borrower, you are exposed to changes in interest rates. Importers and exporters are exposed to exchange rate risks. So all entities are exposed to some kind of market risk. Now, the majority of these market risks can be hedged economically by entering into derivative instruments, or the most common way to do it is enter into derivative instruments. Now, examples of derivative instruments could be forwards, futures, options, swaps. You enter into them to hedge a variety of risk. It could be a commodity risk like the price of gold. It could be a currency risk, an equity risk, an interest rate risk. So entities can use these derivatives to limit or offset their risk exposure. Now, if that's what you're doing, you are doing economic hedging. Now, you can hear nowhere there have I talked about the accounting treatment. And nowhere there did I mention hedge accounting in terms of AASB 139 or IFRS 9. So economic hedging is you've got a market risk, you decide that you want to protect yourself against that market risk, you enter into a derivative. It could be to protect yourself against future cash flows, it could be to protect yourself against future changes in fair values. So before we go on, I thought let's get an idea of how many of you do this. So you order inventory from overseas, you want to fix the cash flow, and because you have to pay, let's say, in US dollar, you enter into a foreign exchange contract to limit that risk. So if we look at our first poll question, do you hedge your risks? Very simple question. Do you hedge your risks? So basically I'm asking, do you get involved in economic hedging? Let's get an idea of our attendees. How many of you actually get involved in economic hedging? So some people say, yes, we always do. So let's say they're an importer. They know they have to settle in an overseas currency, always hedge. They don't like the risk of not knowing what the cash flow is going to be. Others, people say, yes, sometimes. So they have some kind of risk management policy in place to assess whether they should, in a particular circumstance, hedge or not. A number of people are saying no, never, and 10% not sure. So we've got around 53% of our attendees have voted. If you still want to vote, that would be nice. Now we're up to nearly 60%. So let's close that one and let's share the results. So very interesting. 7% of our attendees say they always do economic hedging. 50% says yes sometimes, so there's some kind of process to assess whether we should hedge or not. 34% no, never, and 9% unsure. Very interesting. Thank you for participating in that. If we now move on and continue with our discussion around, so what is hedge accounting? Remember the key concept here is economic hedging doesn't equal hedge accounting. Now, hedge accounting is a technique that modifies the normal basis for recognizing gains or losses or revenue and expenses on associated hedging instruments and hedged items. Because remember, when you do hedging, you've got a hedged item. In a very simplistic English, hedged item is the item you want to protect. The hedging instrument is the derivative. It's the item you use to do the protection with. So the hedged item, you want to protect it. The hedging instrument is the derivative. Now, hedge accounting is just a technique, an accounting technique, where you modify the basis for recognizing the gains or losses on the hedging instruments or on the derivatives or the hedged item. So you can change one or the other or both, so that both are recognized, and this is critical, so that both gains and losses from hedged item and hedging instruments are recognized in profit and loss or OCI, other comprehensive income, in the same accounting period. So really what we're doing with hedge accounting is we try to get matching. Matching, so if there's a profit or a gain on the hedged item, it is offset by a loss or an expense on the hedging instrument, or the other way around. If there's a loss on the hedged item, it's offset by a gain on the hedging instrument. That's what we're trying to achieve when we use hedge accounting. So this is a matching concept that eliminates or reduces, can't always eliminate, but often, if it's set correctly, reduces the volatility in the statement of comprehensive income that would otherwise arise if the hedged item and the hedging instrument were accounted for separately. So it's interesting here, if you look at your hedged item, there's a lot of rules in IFRS 9 on how you account for the hedged item. depending on their classification. We know hedging instruments are always fair value through profit and loss. So your problem is if the derivative is at fair value through profit and loss, and the other one is potentially at fair value through OCI or at amortized cost, you can see there's no matching if we treat them separately. So with hedge accounting, we treat the two together, we try and get this matching going so we can reduce or eliminate volatility in the statement of comprehensive income. So this is hedge accounting is a technique, so we can call it an artificial technique, where we try and reduce that volatility. Just coming back to my statement, economic hedging doesn't equal hedge accounting. What I'm trying to say there is a number of clients, when they speak to us, say, but I do economic hedging. I protect my cash flows. I enter into these hedge relationships. I manage my risks. I absolutely agree with you. Fantastic. If you do that and it works for you and you manage your risk, that's good and that's your decision and that's good. So I'm not arguing economic hedging. Yes, you do it. However, the fact that you do economic hedging does not automatically allow you to use this artificial technique called hedge accounting. You need to pass certain hurdles to qualify for hedge accounting. And AASB 139 currently have quite high hurdles that you have to jump to get to hedge accounting. Where going forward, IFRS 9 has relaxed that a bit, and that's the key benefit, I would say, for most of our clients with IFRS 9. Greater opportunity to qualify for hedge accounting. There's a nice bang here in our office. Please excuse me for that. It's not me. I'm sitting fairly still. Sarah's going to investigate what's going on. So risk management strategies often involve the use of derivatives to manage risk, so your foreign exchange risk or commodity risk or interest rate risk. So examples, a lot of our clients hedge against future fluctuations in exchange rates, US dollar or euro or pound exchange rates, and they use forwards. Also, they could use oil options to protect against the risk of falling oil prices if you're in that industry. Now, when these derivatives are used as a tool for risk management, normal accounting requirements would lead to additional profit and loss volatility because the derivatives that you use are at fair value through profit and loss, but the hedged item could be at a number of different accounting treatments. So hedge accounting is a way to reduce that profit or loss volatility. So that's just another way to put it. So if we look at your new hedge accounting model in IFRS 9, so the objective of this new hedge accounting model in IFRS 9 is to present in the financial statements two things. First of all, they want to present in the financials the effect of an entity's risk management activities that use financial instruments. And also, they want to present or disclose in the financial statements how these financial instruments are used to manage risk. So come back to the entity's risk management activities and how an entity uses derivatives to manage risk. As you know, the whole concept of risk and how organizations manage risk is very topical and in the media quite a lot. And IFRS 9 is saying we want to add disclosure presentation on how we do that. So hedge accounting is accounting for the hedges, is trying to ensure that accounting for the hedges matches the economic substance of the underlying hedge transactions or the underlying economic hedge transactions. That's what we're trying to do with hedge accounting. Still on the objective of hedge accounting, if you look at your risk management objective of an organization, we want to link risk management and financial reporting. So if an organization is entering into economic hedging to manage their risks, Hedge accounting will therefore link that risk management strategy or activity with financial reporting. Also, your accounting objectives is to present the effect of risk management activities in the financial statements. So if we've used economic hedging, what was the effect of that? To what extent did it mitigate or eliminate certain risks? So if you look at your hedging relationships, in order to get to a hedging relationship, you need a hedged item. So that's an item that you want to protect. But you also need a hedging instrument, or usually a derivative, to do the protection with. And that would get you to a hedging relationship. If you look at the types of hedging relationships that's available, you could enter into a fair value hedge, you could enter into a cash flow hedge, or you could enter into a hedge of a net investment in a foreign operation. I have to say the two most common ones would be a fair value hedge and a cash flow hedge. Now, a fair value hedge is a hedge of the exposure to changes in the fair value of a recognized asset or liability, or in the value of an unrecognized firm commitment that could impact an entity's profit or loss. So maybe we have a purchase order to buy equipment for €200,000 in 6 months' time. If you look at a cash flow hedge, now a cash flow hedge is a hedge of the exposure to variability in future cash flows of an asset, liability, or a highly probable forecast transaction that could ultimately impact the entity's profit or loss. So maybe you've got a loan with a variable interest rate. Also, a hedge of the foreign exchange risk of a firm commitment can also be accounted for as a cash flow hedge. So a fair value hedge, a cash flow hedge, or you can hedge a net investment in a foreign operation if that's applicable to your organization. So again, I thought, let's get an idea. We had 50% of our attendees said sometimes they hedge, 7% said always. So for those people, it would be interesting to know, do you currently, I wanted to ask, what type of hedge relationships do you have? So if you do hedging, do you do cash flow hedging? Do you do fair value hedging? Not sure. Even for those entities who don't currently use hedge accounting, which ones would be applicable to you if you did qualify? Just trying to get an idea. I thought that not much of our client base would do hedge of a net investment in a foreign operation, but maybe you do. If you could please vote, that would be great. At the moment, it looks as if most people who voted, and the voting percentage is around 45%, most of you use cash flow hedging. Let's see if we can at least get to a 50% of you that vote, so we can get some meaningful results. That would be really interesting. Very interesting. Thank you very much. So 53% of you, of attendees, have voted. And if we look at the results, very interesting. Of the 54% of you that's voted, 57% say cash flow hedging is the appropriate type of hedging relationship. 13% do fair value hedging. Nobody do a hedge of a net investment in a foreign operation. 30% unsure. I assume that would be people who currently don't do hedge accounting and therefore haven't really evaluated all the aspects. Right. So I think one of the key things, and really a focus for me in this webinar today, is not running the numbers, because the actual mechanics for fair value hedging, the actual mechanics for cash flow hedging, the basic ones, not a huge change. It's more around the qualifying criteria for hedge accounting where we see drastic changes and where there's more opportunity to qualify for hedge accounting. So if we look at this, the qualifying criteria for hedge accounting, we can look at 4 parts. The first part is the formal designation and documentation. The second part is only eligible hedged items, and there's been some changes around what are eligible hedge items. The third one, only eligible hedging instruments, and again, we've seen some changes around eligible hedging instruments. And then the last criteria, you need to meet the hedge effectiveness requirements, and again, there's been some relaxation in that area. It's no longer the corridor between 80 and 125%. So we look at that as well. So we look at each of these qualifying criteria individually. The first one is formal designation and documentation. So very important, similar to AASB 139, IFRS 9 requires formal designation and hedge documentation before you enter into the hedging relationship. So it's very important that we have this in place. And this is what they want. You have to document your risk management objective. So what are you trying to achieve? What is your risk management objective? You also have to document your risk management strategy. So why is the hedge being undertaken? You also have to identify your hedging instrument, so the specific derivative, for example, that you're using. You have to identify the related hedged item or hedge item. So your hedging instrument, your hedged item, both have to be identified. Then the fifth item is the nature of the risk being hedged. So the risk that you want to protect yourself against, very specifically, what is the nature of that risk? Then also you have to decide what is the type of hedge. Some hedges could be a fair value or a cash flow hedge. So up front you have to decide what is your type of hedge. What's your main concern? You want to protect against a fair value change or a cash flow change. And then the last one, very important, you have to document how the entity will assess whether this hedging relationship would meet the hedge effectiveness requirements. So how are you going to assess it? Interesting going forward, and you'll see that later on, it doesn't only have to be a quantitative assessment, it could be a qualitative assessment. If we move on to only eligible hedged items, we've had some changes here. So first of all, what is an eligible hedged item? Now, it's got 3 parts to it. The first part is it is a contract with a party external to the entity, and it is reliably measurable. And the third one is one of the following. You have a recognized asset or liability, and that recognized asset or liability can be a financial or a non-financial liability, asset or liability. So a recognized asset or liability in your statement of financial position, and that asset or liability could be financial asset or liability or non-financial asset or liability. The second option, it could be an unrecognized firm commitment. So that would be a binding agreement where you've got a specified quantity, a price, and a date or dates of delivery. You could also have, as a third alternative, a highly probable forecast transaction. So it's not a committed agreement or binding agreement, but there's anticipated future transaction. It has to be highly probable, though, that that transaction will actually happen, that anticipated future transaction. And then the fourth one is a net investment in a foreign operation. So what is an eligible hedged item? So what is an item that you could actually hedge in terms of a hedge accounting? So you've got a contract with this external party, it can be reliably measurable, and it deals with one of the following. then you've got an eligible hedged item. So a few changes. If you look at hedged items, first of all, risk components. Now, under IAS 39, which is exactly the same as AASB 139, risk components of non-financial items cannot be designated as a hedged item. Now, this prohibition caused many corporates to fail hedge effectiveness testing under IAS 39. Now, under IFRS 9, risk components of non-financial items are eligible hedged items, as you've seen on the previous slides. So this is a big change. Entities can compare changes in the fair value of the hedging instrument, for example, a derivative, with changes in the fair value of a particular risk rather than the whole item. And thereby we can achieve a greater degree of offset with a corresponding reduction in your profit or loss volatility. So very important that risk components of non-financial items are now eligible as hedged items. Big change. So examples of risk components that now can be eligible hedged items, it could be the crude oil benchmark price, which is only a component of jet fuel. It could be the gas oil benchmark price, which is a component of jet fuel. Maybe the diesel benchmark price, which is a component of your diesel purchase contracts, or a coffee benchmark price of coffee purchase contracts, or coal benchmark price of electricity contracts. So we're looking at just one risk component, just the coal component of electricity contracts, or copper benchmark price as part of copper wire contracts, or a diesel benchmark price component of transport or freight contracts. So just a number of areas where we could see change with the adoption of IFRS 9. The other change is around aggregated exposures. Remember, we're still talking about eligible hedged items. Now, in the old model, IAS 39 does not permit derivatives to be designated as hedged items. Under the new model, we can designate a combination of a derivative and a non-derivative as a hedged item. It's important that the requirement is that the risk of the derivative and the non-derivative should be managed as one exposure. So you can aggregate exposures of a derivative and a non-derivative if you manage them as one, because there's now this greater link between your risk management strategy and activities and qualifying for hedge accounting. Aggregated exposures, so you can have a derivative and non-derivative. If you manage them as one, you have an aggregated exposure, and that could now be eligible as a hedged item. The third change around hedged item is equity investments at fair value through OCI. Now, as you know, under the new IFRS 9, we've got a new category, and that is entities can make an irrevocable choice on initial recognition to classify equity investments, so this is investments in shares usually, to fair value through OCI, other comprehensive income. So no change in fair value will go through P&L. Changes in fair value will go in OCI even when you sell that item. So the only thing that will go through P&L would be dividends. So the fair value through OCI category under IFRS 9 is also eligible for hedge accounting. So you can qualify equity instruments that are in this fair value through OCI category as a hedged item. And again, this is a change from what we currently have. Remember, this fair value through OCI, equity investments at fair values through OCI, is a new category in IFRS 9, and which has really been brought in to address a lot of the concerns that we currently have with available for sale equity investments under AASB 139. Also a change around hedged items. To reduce the cost of hedging, entities often enter derivatives to hedge a net position, for example, a net foreign exchange position. Now, IAS 39 does not permit hedges of net positions. IFRS 9 has relaxed some of these rules, and therefore IFRS 9 now permits net foreign exchange cash flow positions as an eligible hedged item. So not all net positions are eligible, but foreign exchange cash flow positions or net foreign exchange cash flow positions can be eligible hedged items. So you can see, if you look at hedged items, there's a basic definition of what a hedged item is, and that's not really changed, but there's a number of changes to what can qualify as a hedged item, and IFRS 9 has really relaxed some of these rules. Also interesting, maybe right at the end, to just sit back and say, so what are the items that do not qualify as hedged items? So that would be items that address credit risk, firm commitments to acquire a business, except for the foreign exchange risk. So the foreign exchange risk can still qualify. So a firm commitment to acquire a business, that's not a hedged item. Credit risk, not a hedged item. Transaction in a company's own equity is not a hedged item. Inflation risk, unless it's specified in a contract, is not a hedged item. So what we've done today around eligible hedged items, we've just looked at, in theory, what's the definition of a hedged item, what are the changes around eligibility, and then we ended off what would not qualify as a hedged item. If we move on to the third one, only eligible hedging instruments. So what is a hedging instrument? A hedging instrument is a designated instrument whose fair value or cash flows is expected to offset the changes in the fair value or cash flows of the hedged item. Now, what is an eligible hedging instrument? First of all, derivatives. So derivatives other than net written options can always be used as hedging instruments, provided that, number one, they are designated by the entity for the entirety of their duration to maturity, and it's with a party external to the entity. So the first one, designated by the entity for the entirety of their duration up to maturity. They're designated, and it's with an external party. The second one is that non-derivative financial assets may be designated as hedging instruments. Quite a few criteria around that, but it's a possibility. And non-derivative financial liabilities that are carried at fair value through profit and loss may be designated as hedging instruments if they are held for trading. So quite a few changes around hedging instruments. If we look at hedge effectiveness requirements, which is the last qualifying criteria, you can see I'm really struggling. I'm trying to get to the 22nd of December to go on annual leave, and now my words are tripping up. I'm tired. So if you look at hedge effectiveness requirements, you will know that currently under AASB 139, this was really an area that a lot of entities struggled with because there was a narrow corridor between 80 and 125%. So they've changed these hedge effectiveness requirements in the new IFRS 9. So first of all, let's look at what is hedge effectiveness. Hedge effectiveness is the extent to which changes in the fair value or the cash flows of the hedging instrument offsets changes in the fair value of the hedged or the cash flows of the hedged item. So to the extent that the one is going up and the other one is going down, you know, that's being effective. Hedge ineffectiveness is the extent to which the changes in the fair value or the cash flows of the hedging instrument are greater or less than those in the hedged item. So, you know, our hedged item is going down by 100. but our hedging instrument is going up by 110. So, it's greater than the change in the hedged item. And that's an ineffective portion. So we assess hedge effectiveness requirements at the inception of the hedging relationship and on an ongoing basis. Therefore, at a minimum, we have to assess hedge effectiveness at each reporting date, or if there's a significant change in the circumstances, whichever comes first. So at least at each reporting date, you have to look at hedge effectiveness requirements. So if you're a listed entity and you do hedge accounting, you have to look at the interim date and the annual reporting date. If you look at the hedge effectiveness requirements, and we've got the new requirements under IFRS 9, 3 particular aspects here. You have to look at the economic relationship between the hedged item and the hedging instrument, and that economic relationship exists, first of all. You have to consider whether the effect of credit risk dominate the value changes, because it's only effective if the effect of credit risk does not dominate value changes. And then you also have to consider whether the hedge ratio results from the quantity of hedged item and hedging used. So you have to look at 3 aspects. Do you still have an economic relationship? You have to look at credit risk and whether it dominates value changes or not. And you also have to look at the hedge ratio. So if we think about the changes under IFRS 9, first of all, and as I've said a number of times, the corridor 80% to 125% threshold has been removed. So you can continue to hedge account even if the hedge was only 70% effective, as long as the 3 criteria on the previous slide are met. So if you still have an economic relationship, if credit risk does not dominate value changes, and if the hedge ratio results from the quantity of hedged item and hedging used to hedge, even if it's 70% or if it's 150%, you can continue. The other big change is that IFRS 9 only requires prospective testing. Currently, you have to do retrospective and prospective testing. So only prospective testing at every reporting date, or if there's a change in circumstances. Then also, you can have a qualitative assessment where the critical terms match. So you look at the quantity, timing, and the underlying risk match. So it's not necessarily just a quantity or a quantitative assessment. It can be a qualitative assessment. Therefore, effectiveness testing has become much easier. So this is a big change. So the new general module permits qualitative hedge effectiveness testing. It only requires prospective effectiveness testing, and the new model allows more economic hedging relationships to qualify for hedge accounting. But the accounting mechanics have not changed. So the measurement and the recording of hedge effectiveness is still required. So which is a big change, and that will really open up the use of hedge accounting to a number of our clients, or it's expected to open it up. The last section that I want to look at before we recap the webinar is the consequences of ineffectiveness following your initial hedge recognition. And here it's good to compare what we currently do under AASB 139 versus the new IFRS 9. So under the current AASB 139, you may discontinue hedge accounting at any time. Now this is again quite a big change, because under IFRS 9, voluntary discontinuation of hedge accounting is not permitted. So you can only discontinue where the qualifying criteria is no longer met. So for instance, the entity's hedge objective has changed, or the hedged item or the hedging instruments no longer exist, or they have been sold, or there's no longer an economic relationship between the hedged item and the hedging instrument, or the effect of credit risk starts to dominate the value changes that result from that economic relationship. So you cannot just discontinue the use of hedge accounting under IFRS 9. That's not permitted. There's criteria. So how to address prospective hedge ineffectiveness? So you've done your hedge effectiveness testing and it's ineffective. What do? You could continue hedge accounting and recognize that hedge ineffectiveness in profit or loss. That's an option. And actually, you should continue hedge accounting. In most, you can't just, move away. The other option, and it's based on a number of assessment criteria, you could rebalance the hedge ratio. And this new concept of rebalancing is a new process that's introduced in IFRS 9. And we'll look at rebalancing examples at length in a separate webinar on how do we do rebalancing of the hedge ratio. And the third option is you could de-recognize the hedge either partially or fully. And a number of items to consider which of the three you should do in a specific situation. So if we do a recap of this webinar, maybe before we do the recap, I thought I'll ask another question. And my question is, would you like to use the new requirements, the new hedging requirements in IFRS 9? So whilst listening to the changes, do you think it will give you an opportunity to use hedge accounting, which maybe you haven't had in the past? If it gives you that opportunity, is that something you would like to investigate? Or you really think still not interested? So the benefits of hedge accounting definitely is that you get to the matching of gains on the one item with losses on the other item. You match it in the same accounting period in profit and loss or OCI. So that definitely is a benefit. And a lot of people traditionally want to do hedge accounting, but they couldn't qualify for it. IFRS 9 is potentially making the qualification easier. And therefore, it's something to consider, or we would advise our clients to consider. At that stage, around 40% of you have voted. Let's see if we can get to 50%. Would you like to use the new hedge accounting under IFRS 9? We haven't looked at the mechanics yet. We haven't looked at the numbers, but at least what I've tried to illustrate is that IFRS 9 opens up the opportunity. So 45% of you have voted. And if we look at the results, 21% yes, 8% no, 72% a maybe. So I would love to speak to you and consider the options and whether it's potentially beneficial to you. If we recap this webinar, to end it off, the key changes from the old AASB 139, there's simplified effectiveness testing, more items qualify for hedge accounting, and we think there would be, why is it not moving? You're still looking at the results. Let me just look at the polls. Is it gone now? Somehow I can't get rid of it. I don't know what's going on. Closed. Yeah, I don't know why you are still seeing the poll results, because I've definitely closed it. That is odd. Yeah, very odd. I do apologize for that. We've got 2 slides to go. There's also less profit or loss volatility when using options forward and foreign currency swaps. So IFRS 9 in a nutshell is more principles based, it's less complex, and it better links to the entities risk management activities. So what is staying the same? I think it's also important to say there's a lot of changes. What's staying the same? The general accounting mechanics of hedge accounting under AASB 139 remain largely unchanged. So the new model retains the following models: the cash flow hedge model, fair value hedge model, net investment hedge model. Entities are still required to measure hedge effectiveness and recognize any ineffectiveness in profit or loss. Hedge documentation is still required, and hedge accounting will remain optional. However, once you've selected hedge accounting for a particular item, you cannot just walk away or discontinue, as we've explained. If you've got any questions that you would like to discuss with me, please send them through. If you would like to meet with me or any of our other BDO representatives, I'm thinking Wayne Basford in Perth, IFRS Advisory Partner in Perth, Clark Gerald, IFRS Advisory Partner, Brisbane, Kevin Frobers, who joined us in October in Sydney, or any of our other BDO partners, please contact us. So this is our BDO IFRS Advisory team. I'm based in Melbourne, Wayne is based in Perth, Clark is based in Brisbane, Stephen is in Melbourne, Kevin is in Sydney, and I can go on. But it doesn't matter where you're located, happy to work with you and discuss this further. I would like to say I do hope you have a good holiday. For those of you who celebrate Christmas, Merry Christmas. I celebrate Christmas, so Merry Christmas to you. To those who don't celebrate Christmas, I still hope that you have a good break over the New Year period, and we'll see you in the new year. The new webinars will be advertised in January on our website. Thank you very much.